This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. A cautious open ahead for Asia after the S&P 500 notches a fifth day of gains. Soft US consumer inflation barely moving the needle on expectations of Fed rate cuts from next month. Also ahead, a rapidly slowing New Zealand economy spurs talk of more and bigger rate cuts ahead. We speak live with the RBNZ Governor, Adrian. And Tencent's US-listed shares slipped despite rejuvenated gaming growth as a weak fintech result reflects pressure from that plodding Chinese economy.
Heidi will be waiting for the markets to open across Asia to see their reaction to the U.S. inflation numbers. Right now, this is the setup with Sydney futures higher by 0.4%. We do have a few markets closed across Asia, including that of South Korea and India. But Japanese futures at the moment pointing higher. We had a little bit of volatility in the previous session after that announcement by Prime Minister Kishida that he wouldn't be running for a second term. We did manage to end the session in positive territory. The Japanese yen also holding at that 147 level. Of course, we'll be watching also the Kiwi dollar holding steady at the moment after that rate cut later today. We also get the Philippine Central Bank decision, which is also a toss-up. Take a look at how we're coming online in U.S. futures because it's really all about the central bank action and expectations of where central banks go from here, right? When it comes to the Fed, it seems that the CPI numbers didn't really do that much when it comes to moving the needle in expectations of that rate cut coming in September, and perhaps no change in terms of an outsized rate cut coming either. So we saw really those CPI numbers cooling for a fourth month after we already saw those PPI numbers coming in below expectations, slowing as well, and not a lot of movement in the Treasury space, although oil is slightly higher, Heidi.
Yeah, let's get some more on those U.S. inflation numbers, Shery, with our global economics correspondent Andy Curran in Washington. And as Shery and I have just been talking about, it didn't really move the needle in terms of market expectations, broadly still following this downtrend that we're seeing for inflation fading. Was there anything in particular that was sort of interesting to you in terms of how it sets up now Fed expectations?
Well, I guess it was another good month for inflation, like you mentioned there. Prices coming down across the board, airline tickets, the cost of clothes, price of gas, price of new and used cars, the cost of medical services, all coming down. So that's all good news. But as you mentioned, though, the big standout was the shelter cost, which is basically the cost of housing, in particular rent, going up. And the hope had been by this stage of the cycle that rents really would be coming off the boil a bit. And this is the biggest driver of inflation at the moment is the shelter component. So that's a clear negative. And then there were some other sticky areas like car insurance, for example, which really has continued to defy the broader slowdown in inflation. But nonetheless, importantly, core inflation having its slowest pace of increase since early 2021. All the broad indicators suggesting that inflation is heading in the right direction for the Fed. This isn't the only inflation metric they look at. There is another core reading coming up in a few weeks where they really drill into what's going on with prices. But broadly speaking, the numbers today suggest that yes, US inflation continues to slow, and of course all pointing in one direction for the Fed.
Yeah, and we'll also be awaiting retail sales numbers on Thursday out of the U.S., right? But when it comes to the Fed, does it move the needle at all when it comes to that 25 basis point cut expected for the month of September? And what about an outsized, perhaps 50 basis points cut?
Well, I think, it would have taken an upside surprise to really upset the Fed debate. Broadly speaking, it had been expected inflation would continue to slow. The Fed themselves have signalled that they are nudging towards a cut in September, like you mentioned. They just need to be more confident about the data. But it should be said that, we have plenty of data between now and when the Fed does meet in mid-September. We're going to have, I think, at least one more CPI read. We're going to have at least one more jobs read. We're going to have, of course, the all-important Jackson Hole gathering where Fed Chairman Powell will speak, and he may or may not give some signals on monetary policy there. So there's plenty of data between now and when they do meet in September to determine what they're doing. Market pricing didn't move that much. They're still, broadly speaking, expecting, I think it's about 75 odd basis points of cuts between now and the year end. So the narrative continues to be for the Fed to cut rates. We'll have to see whether or not the data between now and then will determine, I guess, the size and scale of that cut.
Our global economics correspondent and that current there. And really, it's all about data, isn't it? Because this week, we're also awaiting China's July activity numbers. Out in a few hours today, it looks likely to show that the economy has failed to turn the corner on the worst stretch in 5 quarters. For more, our China correspondent Min Lo joins us in Hong Kong. Min, so how bad could these numbers be?
Yeah, we're looking at quite mixed data. Retail sales expected to grow by 2.6%, better than the previous month. But overall, if you look at the broader trend, that's still pretty sluggish numbers because pre-pandemic, we're looking at numbers of around 8% for retail sales. We are far from that now. That number is likely to be boosted by the summer travel season, so more demand for services, but not so much for goods, though. If you look at car sales, which makes up 10% of retail sales, that's down for the month of July. Industrial production expected to grow slightly slower than the previous month at 5.2%. This would make it the 4th consecutive month of a slower pace of growth for industrial production. And again, some worrying signs there because we did see the Caixin manufacturing PMI contracting for the first time in 9 months, pointing to headwinds for export demand with the U.S. economy slowing down as well. Fixed asset investment expected to remain steady at 3.9%. That's where we see the government speeding up the issuance of local government special bonds, which is key for infrastructure investment. And property investment, that's still not out of the woods, expected to decline by nearly 10%. And so far, that PBOC plan to inject 300 billion yuan in relending facility has seen quite a low take-up rate so far.
The PBOC is also expected to announce the MLF rate today as well. Any surprises expected there?
Yeah, so the expectation is that the MLF will be kept steady at 2.3% after the surprise rate cut of 20 basis points back in July and an off-schedule cut. Now, there is some speculation about whether the PBOC will delay the MLF announcement again to the 25th of this month. That would pave the way for the PBOC to place more emphasis on the 7-day reverse repo rate. But our Bloomberg economics team believe that was just a one-off event. They expect the MLF rate to remain steady at 2.3% today. We do expect a rate cut later this year, but not until the 4th quarter and likely not until after the Fed cut, because also we are seeing this volatility and wild swings in the bond market. The PBOC fighting with traders to lift yields higher, so they're not likely to cut rates so soon, maybe.
Bloomberg's China correspondent Min Lo there. Coming up on the Asia Trade, a look at who may become Japan's next Prime Minister, what lies ahead for the world's 4th largest economy. Pimco also joining us for an update on the political risks ahead of the US election. Plus, we talk markets and tech earnings with UBS Wealth Management and Goldman Sachs. But before all of that, the RBNZ governor joins us live as the central bank dives into an easing cycle sooner than expected. Adrian is with us next. This is Bloomberg. Take a look at Kiwi assets. Of course, a big day when it comes to the Kiwi dollar as well as bonds. We saw that slump in the dollar as well as yields plunging after the RBNZ embarked on its easing cycle much sooner than most market participants had expected. We're holding on to most of those losses at the moment as really we had the sort of broad upside in the other side of the trade. Of course, the US CPI numbers not really moving the needle in either direction when it comes to Fed expectations either. Equities looking a little bit softer this morning. Well, RBNZ Governor Adrian has told a parliamentary committee that the central bank is confident it's done enough to curb inflation after beginning its easing cycle much sooner than previously indicated with that 25 basis point rate cut. Adrian now joins us live from Wellington. Governor it's always a pleasure to have you with us, and particularly the morning after what has been such an exciting development for the bank and for markets. I'll start off by asking you what sort of determines the next few steps for the RBNZ. You've said that 25 basis points is a small move, that you'll proceed gradually. History would show us that the RBNZ tends to go, pretty aggressively in these sorts of cycles. What's going to be the determinant for you, and are there sort of previous cycles that might guide us on what to expect this time?
Yes, so thank you for being on the show again. Greatly appreciated. For us, we are very confident that headline CPI inflation is already within our 1 to 3% target band. Obviously, the data lags the official data, but all of our near forecasts say we're there, and that gives us great confidence that we can now start easing policy. The important things that we've been watching for have actually been around price setting behaviour, inflation expectations, and the path of the non-tradable domestic homegrown inflation components. All are now aligned with low and stable inflation being restored to New Zealand, and that's the outlook for the next couple of years. What that means is we can shift increasingly from a restraint position back to a more neutral monetary policy position. The official cash rate from 5.5 to 5.25 still remains quite restrictive. We see a neutral rate more around the 3% level. So that gives you kind of a scalar. At what pace would we want to get there? At a careful and measured pace to ensure that inflation expectations remain anchored at that 2% target rate. That is our single focus.
You mentioned the neutral rate. The OCR track from yesterday looks like it might have bottomed out actually above some of the estimates from the RBNZ for the neutral rate. Do you think if the recessionary conditions as forecast materialise, there might be a need for that to change? There might be a need for rates to push now below neutral to get the economy and growth back on track?
There are many things that are pointing in the right positive direction for economic growth. So, at this point, we see just the need to remove restraint rather than provide stimulus. There's significant investment activity that is needed in the country. There's a lot of different price pressures. So, at the moment, subject to no future shocks, which is always the assumption you make in a forecast, we think we are in a comfortable control position to remove the stimulus and let sustainable growth take place.
Governor, it's really interesting to see you really focus on inflation as the single focus. Also mention words like comfort and also being calm when it comes to these rate cuts. But I do wonder how much of the impulse also comes from concerns about the growth of the economy. I understand that you also forecast some contractions for the rest of the year when it comes to economic growth.
Yeah, it's all in the parcel. So without doubt, our confidence around declining domestic inflation is because we can now observe quite significant spare capacity opening up in the economy, something that has been absent since pre-COVID periods. So that spare capacity means inflation pressures are coming out, and that means we don't have to do as much monetary restraints. So that's implicit in our projections. In fact, we estimate a minus 0.5% GDP figure for the June quarter. That's still yet to be done, and about a minus 0.2 for this quarter, the one we're currently in. But beyond that, we see positive economic growth coming, and as we can be easing interest rates. So, growth without the inflation.
I understand that hindsight is 20/20, but looking back, would it have been better to have been less hawkish in the May meeting? For example, were you surprised that in New Zealand you saw some of the reaction in the economy be as sudden as it was, as opposed to, say, what's happening in Australia, what's happening in the US as well?
No, we do monetary policy for New Zealand. So, what other central banks are doing is for their economies and their inflation outlooks. So, the committee are very confident we have a strong control now over that future inflation path, and hence we can act like it is. In May, that is a lifetime ago, several months back, and we also spoke in July in our monetary policy. We didn't provide a nice graph for the market to have a look at, but we provided significant heads up around our actions. If we look at the July monetary policy statement, our last line said monetary restraint will be tempered as inflation expectations are expected to continue to decline. That is writ large in the July. Going back to May, in high inflation, north of 4% inflation expectations and pricing behaviour outside of any measure of 1 to 3% inflation, and very limited signs at that point of spare capacity actually growing in the economy. Likewise, a fiscal policy story that we hadn't been able to see. So plenty of reason for caution, plenty of reason to signal we're on hold for the foreseeable future, but here are the risks to the ups and the downs. In July, those risks changed favourably, i.e. pricing behaviour has come back considerably, and likewise measures of spare capacity are all unambiguously going up.
Yeah, it's interesting you talk about the balance of risks, because I think the last couple of times when we spoke, it was always that element of what's going on with non-tradables, and it seems like significantly more clarity has been developed around that element. Do you see the bigger risk as being potentially inflation falling below 2%? Is that even problematic in your view? Or is there also the risk that perhaps this easing cycle has begun a little bit too soon?
For us, 1 to 3% inflation is the range. We aim at the midpoint because that maximises our chance of being within the range and being able to manage any offsetting relative price shocks, which are many and always. So that's the underlying thesis. That's our projections have us at 2.3 from this quarter and staying around that 2% mid-range throughout. Of course, every 6 weeks, we are back at the table looking at the new data that comes. The stuff that we'll be really interested in over the next few months is not really on the output side. That's quite a clear story. It's as much around what's happening to pricing intentions, pricing behaviour. That's really critical. The quicker businesses price for a low and stable inflation economy, the less damage there is to the real economy and employment.
Governor, what's the risk of imported inflation being weaker than you expect, given, of course, that China is your largest source of imports?
Yes, that's the China dividend was a great story for 2 to 3 decades for central bank inflation targeters. It really has helped. We've gone through a significant hiatus through the COVID, now through the trade challenges, geopolitical challenges, etc. So it's kind of nice to see that China dividend story start to be talked about again more confidently. I think the biggest impact for New Zealand was not necessarily the overall growth rates in China, but it's more about the policy and how they decide to achieve those growth rates. Is it more domestic spending, or is it more focus on exporting and manufacturing? The latter does put significant downward risk to import prices. It'd be kind of nice to see a downward surprise occasionally. But more increased spending is the reverse. So, we'll wait and see. Geopolitical tensions, threat of dumping trade, etc. It's going to be a volatile period.
You've spoken at the parliamentary testimony recently about the weakness in growth and how New Zealand needs to get its potential growth rate up. How do you see that happening? Is that through sort of more fiscal channels? And do you worry about some of the sort of structural issues with things like net immigration falling to that 16-month low recently?
Yes, I'm pleased you brought that up. Monetary policy, as exciting as it is really more about the business cycle. For us to get below potential growth, to get spare capacity, if that potential growth is very low itself, then you end up with negative growth, and that's where we are at the moment. We've pulled back on the spending around a low potential economy, and hence we are printing negative GDP. The answer? Improve the average speed capability of the vehicle we're driving, and that is productivity. That comes down to doing the same thing better and doing better things, productivity and innovation. What that needs is a lot of capital deepening. We are a very capital shallow economy. We need significant investment, in particular in infrastructure, and we need to be thinking far more long-term and consistent about what that looks like and how that will be net positive.
Governor, it's always such a pleasure speaking to you, especially after such an exciting rate cut decision. Adrian, he's the governor of the Reserve Bank of New Zealand. Thank you. Coming up, hedge funds reshuffling their tech portfolios following the blistering AI rally. We'll get the highlights of the latest 13F filings next. This is Bloomberg.
Well, hedge funds are continuing to buy into some of the biggest tech names, are reshuffling their positions in the AI boom. Our finance editor, Adam Haidi, joins us now for more in terms of what we can glean from these 13F filings. And we've seen some changes when it comes to the big names like Apple and Nvidia. What's going on?
Yeah, well, maybe we start with Michael Burry, because there has been interesting developments there with skill and asset management. And I think one of them is the Alibaba stake, which he's obviously continued to increase a little bit further. But, you know, more broadly, what he's doing really there is pulling back on the overall equity exposure in the second quarter. So remember, this is only through the end of June. It doesn't incorporate kind of the last 6 weeks. And that second quarter was a decent quarter for equities, of course. So he's obviously used that to dial back some risk, cutting that overall stock portfolio in half. So that's quite telling, I think. But, you know, more broadly, you're seeing, you know, exiting of a few other positions. You know, some have done well, some have done a little better. HCA Healthcare, Citigroup, obviously Block and Cigna. And then also reducing a position in both JD.com and the luxury reseller Real. So, you know, quite a lot of tinkering, but I think it is through the end of June. We did see, you know, pretty broad good equity performance. So I think you need to remember that it is in that context that these changes were happening.
What else are we seeing sort of more broadly? Obviously, we mentioned some of the changes in Apple and Nvidia. Has this sort of recent turmoil had or will have much of an impact, do you think?
Yeah, I mean, Nvidia's been obviously a huge story, and it's not. You wouldn't have thought it too surprising for people to be dialing back their positions in a stock like that. That's obviously done, you know, very, very, very well. The AI kind of story as it develops is going to. I think that's what we're going to see continually in the cycle, right? You're going to see kind of ebbs and flows of where people who are following these companies for the long run see an ability to trim positions or to add incrementally to positions. But clearly, the Apple movements were quite notable. It did crop up quite a lot that people were adding to their Apple positions in the second quarter. And also on the flip side of that, with the diverse nature of how the tech story is playing out, what you did see with Microsoft was quite a lot of investors, about 140 in total, reducing their positions in Microsoft. So, you know, clearly the Apple story is still a long-term journey for a lot of these firms. You saw Janus Henderson and Third Point. They were among the funds that were adding to their Apple position. But, you know, there's a lot of nuance in those tech positions now, especially as we've been hearing with the Google news this week and a lot of the regulatory concern that continues to bubble in some of those areas of big tech.
Yeah. Watch this space. Our finance editor Adam Haidi there with some of the interesting sort of things that we saw in those 13F filings. Coming up, we take a look at who might be vying for Japan's top job after Prime Minister Fumio Kishida said he won't be running for a second term. Temple University joins us with their take next. This is Bloomberg. This is the Asia trade. We're about 30 minutes away from the major market opens here in Asia. Taking a look at some of the top stories that you should know. US core inflation eased for a fourth month in line with estimates, doing little to alter bets that the Fed will start cutting rates in September. The data bringing a degree of relief to these markets after last week's meltdown. Tencent reporting better than projected earnings, affirming investor hopes that China's gaming industry has turned a corner. But its US listed shares fell, with the fintech segment recording its slowest growth since 2022. And we'll be getting China's July activity data in just a few hours' time. Those numbers are likely to show that the economy has failed to turn the corner on its worst stretch in 5 quarters. Shery.
And Haidi, Japan looks set for an unusually competitive race to replace Fumio Kishida as the next prime minister. Whoever wins the LDP leadership will face challenges including inflation, volatile financial markets, and of course, the transition to a new president in the United States. Let's bring in our next guest who's surprised by the timing of Kishida's decision to depart. Jeff Kingston is professor of history and Asian studies at Temple University here in Tokyo. Jeff, great to have you back. So, we're about a month away from the expected leadership vote at the end of September. How does this set us up for the next month?
Well, yeah, next week they're going to decide when the LDP presidential race will happen. This is sort of a shock, I think. It takes a little while to digest the implications, but it seems that party heavyweights sort of nudged Kishida to the exit, saw him as heavy baggage. And what he acknowledged in his press conference was that the party and politicians have lost the trust of the public. So this is hitting the reset button. And the LDP hopes that a new leader, a fresh face, will improve its fortunes because it and Kishida have not been so popular.
Right now, there doesn't seem to be a clear candidate to succeed him. How much more political uncertainty could this bring for the next month? And what are your expectations of who could come out on top?
Well, there's a limited pool of viable candidates. I don't think it's going to create too much turmoil. Probably one of the leading candidates is a security expert, Shigeru Ishiba. He is very popular with the public, not so popular among his colleagues. He's known for being arrogant and doesn't suffer fools easily. And so he's made a lot of enemies within the party. But it does seem that former Prime Minister Suga is now in his corner. And the key will be whether or not he can win over the former Deputy Prime Minister Aso and get his support within the party, because it's a two-stage election. First, it is the LDP members and prefectural chapters, and then who emerges from that as leaders in the race will go into the Diet. And so back in 2012, Ishiba bested Abe in the first round, but then in the second round, Abe in the markers of the Diet. So his weak support among Diet colleagues is a big question mark. And so who might also vie? Party Secretary General Motegi, but he's been sort of implicated in the slush fund scandal that brought Kishida low. Sanae Takeishi, she is a perennial candidate, but she's way too close to Abe. And when you think of Kishida, his downfall is really in trying to cope with the toxic legacies of Shinzo Abe. First of all, there was the Unification Church scandal, the slush fund scandal, both of them heavily involving members of the Abe faction. And the third thing is it's the economic turmoil, the inflation. All of this is it's an unraveling of Abenomics. And it's not going to be easy. And we saw last week how that volatility hit the markets.
I think one of the points that you make was my reaction when we saw this headline cross, why now? Because this, in particular when it comes to the political fundraising scandal, this has been going on for the best part of a year, since last year. Is this a change that they really needed to have in terms of the disruption?
Well, they have two sets of elections for the Diet coming up next year, and I think a lot of people doubted that the party would do well under Kishida. So he sort of served his purpose, and now they're looking for somebody who can offer perhaps more dynamic leadership. Kishida has been relatively effective in foreign policy and on security policy, so he has accomplished quite a lot. But he is a self-effacing, modest sort of leader. Often people think of him as sort of gormless, and that has actually been his strength. Is that because he doesn't come across as threatening and decisive, people more or less give him a lot of slack. And so had Abe proposed doubling the defense budget, the backlash would have been huge. Kishida does it in this sort of, modest sort of way. It went through. So it'll be interesting to see as they transition from somebody who has weak leadership skills to somebody who might be more assertive.
It's interesting you talk about Abe because it...
sorry.
No, continue. I was actually just going to ask you whether you see any of the potential candidates as being able to kind of emulate the sort of personality, politics and the charisma that we saw from Shinzo Abe.
No, I don't see any of the candidates being able to be that sort of charismatic leader. And, you know, Abe was very telegenic. Certainly nobody would accuse Ishiba of being telegenic. The party secretary general Motegi, he's got a very low profile in the public. Koizumi's son is quite popular, but he's, 41. And when he served as environment minister, he wasn't all that impressive. So I think it's not going to be his time this time. And the one person who a lot of people seem to like is Taro Kono, except not many of those people are in the Diet or among his colleagues. So even though he's perennially mentioned as a leading candidate, his chances aren't good because it's difficult for him to get much support among his colleagues. And so that's what he shares with Ishiba. But I think right now, because of the turmoil in the world, saber rattling in China, missile launches in North Korea, perhaps Ishiba, as the security expert, might be the right person for the job.
Yeah, that's such a unique political environment for Japan, right? When it's really about lawmakers inside the Diet as opposed to just public sentiment. But when it comes to those geopolitical challenges that you mentioned, there are some names over there that could be seen as too hawkish for its neighbors. Like Takaichi, for example, visiting Yasukuni Shrine. That's a big no-no for Asian neighbors. What could we expect in terms of some of the flare-ups depending on how this goes in September?
Well, the one thing that Kishida did was to mend fences with South Korea, and that's no mean feat. So he managed that quite well. It does seem unlikely that the thawing in relations will outlast either Yoon or Kishida, but he did make a lot of progress during his time in office, certainly something that was unimaginable under Abe. You mentioned Sanai Takeishi going to Yasukuni. Her real problem is she is seen to be too close to Abe, and because the scandals, trace back to Abe, I think that that's not going to reflect well on her. So I don't think Yasukuni is going to be quite the litmus test this year for the leadership contest as it may have been in the past. I think the key is the LDP knows it's lost the public trust. Why? Huge slush fund scandal, unreported campaign contributions, and then they had a chance to initiate reforms. Kishida actually wanted much stronger reforms, and his party colleagues blocked them. And so I think the public looked at this as an empty gesture, whitewashing, and nothing will change. And this public skepticism has translated into ebbing support for the LDP. So I don't think that leadership change is going to really restore public trust. I think that has really descended into a deep hole, and I'm not sure there's any leader of the LDP that can help it climb out of that. But I think people want to have somebody who knows what they're doing and somebody who's experienced. And so in that category, I think the three leading candidates would be Ishiba, Motegi, and Kono. But we'll have to see how that plays out. One of the interesting things that Ishiba has said is he supports an increase in interest rates. Normally, LDP candidates don't comment on things like financial markets or interest rate policy. So it's sort of a bit unusual. And so it'll be interesting to see how markets react if he indeed does become the next party leader.
Jeff Kingston, always great to have you with us, Professor at Temple University. Well, coming up, Vice President Kamala Harris is rising in the polls as the Trump campaign switches gears after Joe Biden's unexpected drop from the November race. We're talking US politics and global risks with Pimco next. This is Bloomberg. I was just looking at how gorgeous your suit is. A new Quinnipiac University poll suggests that Democratic presidential nominee Kamala Harris is leading her Republican opponent, Donald Trump, in the swing state of Pennsylvania. And it's just the latest survey engaged to show Harris is encroaching on Trump's polling lead since she replaced President Biden on the Democratic ticket. She is set to address the Democratic National Convention in Chicago next week. Let's talk about the state of the US political economy, some of these global risks too, with Libby Cantrill, who's a head of US public policy at Pimco. Libby, it's so great to have you here.
So great to be here.
And at such a time of global uncertainty, I feel like we have been saying that for the best part of the last decade. But when you're talking with clients at the moment around the world, what are they asking you and what are you saying?
Yeah, so I think they're just trying to, firstly, make sense of the U.S. election and where things stand, where the race stands. And of course, it's understandable because it has been a dizzying 5 weeks from the horrendous debate to the failed assassination attempt to, of course, Biden dropping out and now the Democratic Party coalescing around Harris. What we're telling our clients, one, is that Harris may be sort of experiencing a Harris honeymoon, if you will. I think Democrats are so relieved that they have somebody on the top of the ticket that they're enthusiastic about, that, there is a lot of excitement, a lot of enthusiasm. As a result, we would just advise our clients to just wait until September. That's when folks, usually after Labor Day in the United States, kind of start really re-engaging. Of the really critical swing states, because of course Americans don't, it's not a national election, it really does come down to just a handful of swing states. The most important is Pennsylvania. So to your point just earlier about the fact that Harris is now leading Trump, and again, wait until September to see where that poll settles, but Pennsylvania is the most critical swing state. Really, in many ways, the election will be decided by Pennsylvania. Harris basically has to win Pennsylvania to win. So our clients are asking about that, and then they're also asking, of course, about economic implications, the chances of tariffs, tax cuts, what happens to the Fed. So both about the state of the race, but then obviously about economic implications and what it means for markets.
Yeah, and with those implications, obviously we're expecting sort of more fiscal from either administration that takes over or sort of sustains some continuity going into January. But do you think that's necessarily the pro-growth, pro-inflation impact of tariffs kind of headache for the Fed picture that perhaps we're looking at?
Yeah, so two things. What we're telling our clients is the biggest loser in November, regardless of who wins, is the U.S. deficit. And that's not necessarily because we're actually expecting much more spending. We do expect if Trump gets elected, he will extend all those expiring Trump tax cuts. That's not necessarily going to be stimulative. That's more of just status quo, but it will be expensive. If Harris gets elected, she most likely will have to extend most of those, just politically speaking. So deficits will certainly increase. And then, of course, the really elephant in the room in the United States is that neither candidate will do anything about the most expensive part of the government's budget, which is entitlement spending, Medicare and Social Security. So deficits are going up. It may not be stimulative, but they're certainly going up regardless of who wins. And then to your question about, tariffs and the Fed, we'll see. And if President Trump does get elected, is it, just as much bite as it is bark, right? Because Trump 1.0, there was a lot of bark, there was some bite. I think our expectation is that he ideologically really wants to decrease the goods trade deficit between the U.S. and other countries. So not just with China, but with other countries. Now, Australia actually has a surplus with the U.S., so maybe they'll be saved. But we do think that he will use tariffs in a more strategic way, not so tactical, not so transactional. That actually could be worse for the market because it might just mean that he's putting them on just to get that trade deficit down. Now, in terms of just your last question about inflation, though, in terms of kind of the mixed implications for both inflation but also growth, because tariffs cut both ways. They can increase inflation for sure, but if countries retaliate, they can also hurt U.S. growth. So, our economists expect that you'll also see kind of maybe a stagflationary environment should he do exactly what he said he will do, and I think we should all take that with kind of a grain of salt.
Libby, first of all, so great to have you on this side of the world. But when it comes to your point of bark versus bite, I mean, we saw that from the Trump era, especially when it comes to trade and tariffs. But that bite kept on going through the Biden administration when it comes to those restrictions against China. when it comes to this side of the world, what are the biggest issues and where do you expect to see some changes and just some more continuity when it comes to the U.S. Actions against, say, Beijing?
Yeah, I mean, it's such a great point. And honestly, while President Trump was the person who really, I think, focused the minds in Washington on China, there had been sort of this undercurrent of sentiment and sort of skepticism towards China really since that that fated vote in the House of Representatives and in Congress about allowing for China to enter the WTO back in 2000. So in some ways, he just sort of grabbed on to sentiment that was already existed. So of course we saw Biden extend those tariffs and actually add on to those tariffs most recently. I think in addition to tariffs, and of course there will be just some differences between a Harris presidency and a Trump presidency on tariffs, but something that they will have in common are more export controls. I was in Asia about a month ago speaking with clients there, and interestingly, that is something that folks are really concerned about. These are prohibitions of selling U.S. technology to the region, and I think that will continue under either president. Another thing that there's more scrutiny about how U.S. investors are investing in China, and the Biden administration has already started a pilot program to look at private investments in specific technological sectors. But I think that if particularly if Trump is elected, could see that broaden into more sectors and even outside of just private investment, potentially public security. So those are two themes that we're talking to our clients about: export controls, more kind of scrutiny on U.S. investment into China. Now, if you're not a U.S. investor, obviously you won't be implicated by that, but it does have economic implications for China as well. Obviously, foreign direct investment in China has decreased very significantly, and if U.S. investors feel like there's too much political risk about investing in China, that obviously has implications for its sort of economic, recovery, if you will.
Yeah, and the sort of macroeconomic fundamentals are not exactly appealing at the moment either. So you've got that. Obviously, the tech bifurcation continues on foot as well. There's all the now assumption that was going on in the Middle East will going into 2025. Is that something that your clients are concerned about? Because it feels like markets at this point are very good at discounting, risks that they think. Yeah, exactly.
Yeah, I completely agree. And we talk to our commodities traders about this all the time, and they're always a little bit surprised by the market's reaction, by kind of how sanguine it is, because of course it's not necessarily the base case, but a broader regional war, I mean, the chances are much higher than they were certainly a year ago in terms of, Iran and escalation between Iran and Israel in particular. So that, I think that the Biden administration will do everything it can do. And you've seen diplomats get on planes to try to sort of, take down the temperature in the region. But certainly that is just a tail scenario, and probably a bigger tail than it was, certainly a year ago.
Libby, so great to have you with us.
So great
Libby
to come back.
Cantrill, really good to have you with us. Head of U.S. Public Policy at Pimco. We do have breaking news here out of Japan at the moment. We are getting the GDP annualized quarter-on-quarter numbers, and it's a beat by a big margin, gaining 3.1% for the second quarter. That's the preliminary number. The expectation was only for growth of around 2.3%. Also, this is really a rebound from that contraction that we saw in the previous quarter. When it comes to the quarter-on-quarter growth, GDP seasonally adjusted growth of 0.8%. Also, again, rebound from a contraction in the previous quarter. We'll have more ahead on the Asia trade. This is Bloomberg. Tencent's U.S.-listed shares slipped despite posting better-than-expected net income, while Alibaba and JD.com are up next. Annabelle Jewelers joins us with more. Bell, so we were expecting some strong numbers, so what happened?
Well, actually, we did get the strong numbers. That's what's kind of interesting out of this reporting from Tencent overnight. Let's talk about the bright spots first, because this was in the gaming division in particular, and that's what helped that surge we had 82% jump in net income. Gaming, it's been quite strong for Tencent rather. They had the release of a key title in the period, Dungeon and Fighter Mobile or DNF Mobile, and that's, as we were talking about yesterday, been one of the most downloaded, generating the most revenue, and so that tells us perhaps the gaming industry in China is finally turning a corner. So that's positive for Tencent's business. What else is a key positive in this was advertising, because we saw some better revenue coming there, around a 20% jump as well in the quarter. However, as you say, we saw the ADRs slipping in the overnight session on Wall Street, and that really related to not so much a contraction, but anemic growth that we had in Tencent's biggest business arm, as the FinTech and Cloud Services division, around a 4% increase in the period. It's just not enough to really impress investors, and that's why you saw that drop there of more than 3%.
China's economic weakness more broadly could show up in the numbers, in particular when it comes to Baba and JD.
Yeah, that's right. I mean, and to make that point, Tencent, that FinTech Cloud Services arm, had been highlighted as one of the most susceptible to ongoing weakness in China's economy. But yes, it's really that focus on the key e-commerce players, Alibaba, JD.com, that are already being pressured by those low-cost startups or newer entrants in the space, Shein, Temu. But today we've got those Alibaba numbers here. You can take a look at what we're expecting there. Revenue is actually expected to have increase, or sales rising 5.6%, but Alibaba is really putting a lot of money and cutting costs for consumers to try and increase its market share. That's similar to what JD.com is doing as well, Shery.
Annabelle Jewelers there with the latest on tech earnings out of China. And of course, as we continue to watch the Japanese yen now trimming some of those earlier losses in the session, with GDP surprising to the upside, annualized growth quarter-on-quarter 3.1%, rebounding from a contraction in the previous quarter. The market opens in Tokyo and Sydney are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. And of course, Haidi, we saw another session of gains in the U.S. Given softer inflation on those CPI numbers. Here in Japan, we're watching GDP surprising to the upside in the second quarter on private consumption.
Yeah, this is, of course, we also continue to watch the political developments, the domestic political developments when it comes to Japan. Who's shaping up in this leadership race to potentially replace Fumio Kishida? There's a lot going on, but of course, whether or not that sort of GDP number moves the dial for the Bank of Japan is the question.
It just really gives it more ammunition in terms of having been correct in raising rates back in July, right? I mean, the economy is starting to see some sustainable recovery. That's the hope going forward. But the fact that we came in at 3.1% annualized growth quarter-on-quarter for the second quarter after contracting almost 2% in the previous quarter, this sets up a positive backdrop for what the BOJ has been trying to do in terms of normalizing policy. But you said it, a lot of news to digest here in Japan, given the news that Prime Minister Kishida is not running for a second term. Take a look at how markets are looking right now. Not a lot of movement on the Nikkei, but the Topix is gaining about 0.25%. And the Japanese yen holding at that 147 level. We're losing ground a little bit throughout the session, but then we got the stronger GDP numbers and the yen trimming those losses against the U.S. dollar. Of course, some of the expectations has been also that depending on who is a likely candidate to come out victorious in the September elections here in Japan, there have been a couple of candidates, including Digital Minister Taro Kono, talking about wanting the BOJ to hike rates to strengthen the yen. So there was a lot of speculation that depending on who gets elected as well, the trajectory of the yen could fluctuate a little bit. Take a look at the 10-year yield, and we're holding at that 81 basis point level, Heidi.
Yeah, taking a look at what we're seeing when it comes to Australia and New Zealand. In New Zealand, where trading has been underway for a little bit, and of course still reacting to that sooner than expected start to the easing cycle from the RBNZ yesterday. We see the Kiwi dollar kind of steadying after those losses, but still, of course, holding on to the majority of those losses and the slump that we saw when it comes to the move in yields as well. We did speak to, of course, Governor Orr a little bit earlier and really reiterating the measured pace at which they aim to lower that cash rate and flagging some of those risks to growth as well. Speaking of risks to growth, we're also watching out for jobless numbers out of Australia. The labour market numbers likely to show that employment is rising at a pretty solid clip, but perhaps not fast enough to prevent that further creep higher in the overall jobless rate. The Aussie dollar is pretty unchanged going into that data drop. We're also watching US Treasuries there as well. Not a lot of movement when it comes to the CPI numbers, but we are hearing from Austin Goolsbee about some concerns over the US labour market. And very quickly taking a look at oil and broader commodities, watching for those Aussie miners potentially to continue seeing that decline. Oil, though, halting that two-day drop as these tensions in the Middle East are sort of battling it out when it comes to the narrative on the build-up of stockpiles. Shery.
Yeah, our next guest still expects a soft landing, which will provide a positive backdrop for risk assets. Hartmut Issel is head of APAC Equities and Credit at UBS Wealth Management and joins us now from Singapore. Of course, we're really, Hartmut, expecting so many different data points at the moment. The 10-year yield in Australia also falling to the lowest level since July of 2023. We have a lot of movement in all asset classes. How should investors hedge for this, given, of course, the uncertainty surrounding politics, central bank policies as well?
Hedge, actually. Then I'll straight away say gold, because gold, you have a couple of positive factors right now. So when the Fed then finally starts to cut, right, and gold as a non-interest-bearing asset, that sort of diminishes a bit your competition you have from the interest-bearing assets. So that's a positive from a cyclical point of view. Yes, you can certainly hedge geopolitical risk, but that's pretty much always been the case. And in addition, what we're also observing is pretty much central banks, especially from EMs, interestingly, acting as not very price-sensitive buyers also in the gold market. And I think to a large extent that is structural. So you have a lot of factors actually that, in addition to the usual geopolitical hedge function, support gold at this point. And we see almost 10% upside towards the middle of next year.
How much of the unwinding of carry trades have we seen so far? I mean, the Japanese yen, given the political developments here as well, has been fluctuating pretty much, of course, after the BOJ rate hike as well. How much of those carry trades have been unwound, and how much of the source of volatility could still come from that sector?
Yeah, we try to triangulate, because that's the crucial question. How's the positioning now? We'll only know in hindsight, but according to our estimates, probably mostly done. So at least in the near term, over the next couple of months, we wouldn't expect a further move here for the stronger side in yen. Then if you look more into next year, maybe middle of next year, then that's a different story again. But by the way, we don't think the move comes so much from the yen or whatever the BOJ does. It ought to come from the US side. So especially 2-year yields in the US going down further as the Fed sort of enters its multiple rate cuts cycle. So that's the driving force here. Yeah, so long story short on the yen, I would say very near term, probably flat from here, not much strength, but then afterwards the strength probably resumes again.
What are your views when it comes to some of the alternatives where valuations are actually appealing by the likes of China, for example? I know we're getting domestic activity data. The broader direction of the economy doesn't seem to be changing, but do you see opportunities?
Yes, would say we see two sides. We have what we call a barbell strategy in China. So the SOEs, which certainly, as you rightly point out, right, they're not expensive at all, but they have begun already, right, with their sort of return improvement plans, share buybacks, all these things, higher dividends. So that's pretty solid, quite interesting. And on the sort of more growth side, internet, I'd say right now we are in a phase where the surprises mostly come from the margin side, right? So based on the cost savings, maybe also paring down investments in most cases over the last couple of quarters, so that bears fruits now. For also the top line to accelerate a little bit more, we possibly have to wait until next year. But it's good that that's the next leg in that story. So yeah, we think there are interesting opportunities in China at this point.
How do you feel broadly about the tech and AI capex story after what we've seen over the past week and a half?
Yeah. We think the correction is a buying opportunity. So fundamentally speaking, for two reasons, I would say. A, we have, for the most part, seen capex again rising, right? So on all the companies that invest in the hardware or GPUs and all these things, they tell basically they don't want to miss out on this wave. But perhaps even more importantly, because some people in the market have sort of questions and say, okay, AI becomes a show me the money story. What they mean, of course, is will these investments, these heavy investments, eventually pay off in end demand? And there, I think from a number of really heavy industry players, right, we had comments that yes, actually that sort of demand, while it's early, but certainly exceeds their expectations, right? And they're not selling only to tech companies, they're selling to all the sectors. So it seems like slowly but surely these also other industries are catching on. So I think from that point of view, to me, that reads like a buying opportunity into the correction.
Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. Great to have you with us. As we're getting breaking news right now, we're hearing from the New York Times that the president of Columbia University, Minouche Shafik, has resigned after months of far-reaching, of course, fury at her handling of protests over the Israel-Hamas war. Minouche Shafik is the third Ivy League president to resign in the wake of these protests surrounding the Israel-Hamas war. This, according to the New York Times, says the president of Columbia University has now resigned. Heidi.
Yeah, we'll be monitoring those developments. In the meantime, Shery, I'm also watching these bond markets when it comes to the move that we see in Aussie yields. We did know that Australian bonds were set to open higher. Of course, we are getting the jobs numbers a little bit later. That's expected to show perhaps a ticking up of the unemployment rate, despite an overall employment situation being improved. But we are seeing that 10-year yield falling to the lowest level since July 2023. That jobs report likely to show that sort of solid clip of employment being added to the economy, and we'll be watching that very, very closely as well. Taking a look at some of the movers that we're seeing very early in the session. We're less than 10 minutes or so into the start of trading here across Asian markets, including Sydney. BHP, of course, those union talks over its Chilean copper mine. These talks fell again with a strike going into now a second day. So we are seeing a little bit of downside pressure there on BHP Group, up by about 0.8%. So that failure to sort of get negotiations back on foot, breaking down the two sides, failing to agree on conditions over the conditions at the world's #1 copper mine at Escondida, now going into a second day of strike. So that suspension of the strike involving about 2,400 workers was actually one of the conditions to continue with the talks. They have now fallen apart again. We're also watching Treasury Wine. Some of these numbers, they're seeing full year EBIT coming in at 780 million to 810 million. That is sort of perhaps on the slightly weaker side of expectations. Origin in focus as well as quite a bit of downside. Underlying profit for the full year missing estimates. We'll continue to see some of those mining and metals names trading lower today. More ahead on the Asia trade. This is Bloomberg. China's July activity data is out in a few hours, likely to show the economy has failed to turn the corner. This is now the worst stretch in 5 quarters. For more, our China correspondent Min Min Lo joins us now. So Min Min, out of some of these indicators from retail sales to industrial production to fixed assets, what are we sort of focusing on specifically?
Yeah, we continue to see this two-track recovery in the economy, with retail sales performing much weaker than industrial production. Retail sales expected to improve to 2.6% from the previous month, but still overall very weak trend there, because pre-pandemic levels we were looking at retail sales of around 8%. That's lifted by the summer travel spending, but sale of goods is still not up, especially when it comes to car sales, which makes up 10% of retail sales. That's down for the month of July. Now, industrial production expected to grow 5.2%, slightly slower than the previous month, and this will be the fourth straight month of slower growth. Again, some worrying signs, because we did see that a Taishan manufacturing PMI contracting for the first time in 9 months, pointing to more headwinds when it comes to export growth for China. Fixed asset investment expected to remain flat at 3.9%. The government speeding up the issuance of these local government bonds to inject more infrastructure investment to lift the economy, to help offset that weakness in property investment that we're seeing. Negative 9.9%, slightly better than the previous month, but still not out of the woods yet. The PBOC's plan to inject 300 billion yuan in that relending facility, not seeing a huge take-up rate right now.
I mean, we do have the PBOC also coming out with the medium-term lending facility rate today. What are we expecting?
Yeah, we're expecting the MLF rate to remain steady at 2.3%. That's after they made that surprise rate cut of 20 basis points back in July in an off-schedule cut. We expect a further rate cut later this year, but not until the fourth quarter, and probably not until the Fed cuts as well. And at this moment, we are seeing just a lot of volatility in the CGB market, lots of wild swings as the PBOC battle the traders to lift yields there. So we are not expecting them to cut rates yet at this moment.
CGB yields, in the meantime, dropping across the curve yesterday, and investors even looking to evade regulators. There's so much going on for Chinese bonds at the moment.
Yeah, so you have these Chinese traders from the non-bank financial institutions, including the insurers, who are specifying to their brokers that, yes, they want to buy bonds, but not from the large state banks, because these banks have been asked by regulators to keep a track record of their counterparties, and the traders want to evade that, and they say they are willing to pay a premium even above the asking price of the state banks for the 7- and 10-year bonds. And obviously this is distorting prices in the market, and then the PBOC came out to say that they will crack down resolutely on these illegal activities. That's according to the PBOC-backed newspaper. And, the PBOC has been in a battle with traders trying to lift those yields. It worked for a few days, but now it's kind of going nowhere. Yesterday, we saw that yield curve dropping across the board, down 3 basis points for the 7, 10, and 30-year bonds. That is after that weaker than expected credit growth data, where you saw this contraction for the first time in 19 years when it comes to new loans for the real economy. So investors are flocking back to bonds. There's nowhere else for them to put their money now, not the property sector, not the stock market. Deposit rates are not attractive. So analysts are saying that if the PBOC really wants to engineer a lift to the yields in a sustainable way, the government needs to inject more fiscal stimulus into the economy.
Bloomberg's China correspondent Min Lo there. Take a look at how markets are trading right now, especially here in Japan, because we are seeing a little bit of a continuation of those gains that we saw this week. We had a little bit more volatility in the previous session, given, of course, Prime Minister Kishida announcing that he wouldn't run for a second term. We did manage to end in positive territory. The Nikkei continues to gain ground. We have energy, communication stocks, and financials leading those gains. The Japanese yen also has been fluctuating a little bit, giving up those losses from earlier in the session. This after we got the second quarter GDP numbers, so pricing to the upside, growth of 3.1% on an annualized basis. Our Asia economy and government senior editor Brian Fowler joins us now. There's a lot to go through, but at least the headline number looks pretty positive.
Yeah, Shery, I think on balance, it's definitely a bullish report. So that annualized growth far exceeds the consensus estimate of 2.3. And the main point is that it was all driven by domestic demand. So we saw personal consumption rise 1%. That beats the consensus estimate, and it's also the first increase in more than a year. And even CapEx was a blip above the consensus estimate. So that's definitely a good report that shows that domestic demand is at least solid and maybe a little bit better than we thought it was.
Do you think Governor Huerta is going in there and just sighing relief? He got so much criticism after the rate hike, but then we saw real wages turn positive, and now we have a stronger than expected GDP number.
Yeah, I think he's definitely feeling pretty good about this report, vindicated to some degree. Keep in mind that this is the April through June data, and it doesn't fully reflect the huge wage increases that were agreed this spring. The BOJ has said that those wage increases probably start to show up in payrolls in June, and maybe about 80% of that is reflected. So there's still even a little bit more upside on that to come in the next quarter. And again, Ueda has been looking for domestic demand for a while, and now we're seeing it. So it's definitely it should take a little bit of the pressure off him. He's going to be speaking in Parliament next week to talk about the
I know, during Jackson Hole.
Yes, very exciting times.
Does it it takes the pressure off, but does it embolden policymaking going forward, do you think?
Yeah, Heidi, we're going to be watching very closely to see what happens over the next few months. And at this point, there is a BOJ meeting in September. I don't think anyone really expects the BOJ to make a move at that point. So there's no real pressure over the next couple of months. The question is, does the BOJ resume hiking later this year? I think most economists do expect that to occur maybe later than previously thought, so maybe not so much October. But I think December still looks, if all things stay, go as we see them now, December would look like a live meeting, possibly early next year. Of course, a big factor will be the Fed. We've seen growth slow. We saw inflation cool overnight. So the big question is, does the Fed cut interest rates in September? And if so, to what degree does it do so? And that could influence the BOJ going forward as well.
Our Asia Economy and Government Senior Editor Brian Fowler here with the latest GDP numbers out of Japan. And of course, that economic trajectory very much affected as well with what happens on the political front. Japan looks set for an unusually competitive race to replace Fumio Kishida as the next prime minister. But Bloomberg Opinion columnist Garode Reedy says it could open the door to a chaotic era. Garode joins us now in Tokyo. Garode, so can we expect just more political uncertainty ahead, given that we are not seeing a clear candidate to really replace Kishida at this point?
Yeah, I think what's interesting about this time around compared to, let's say, the last 10 years of Japanese LDP leadership elections is that, as you say, there isn't a clear person who's going to succeed. When Shinzo Abe was in power, he really was unchallenged within the party. When Abe stepped down in 2020 due to his health, the party very quickly coalesced around Yoshihide Suga. Kishida himself was a logical appointment, quite centrist appointment within the party. Now it's wide open, really, this race, and there's a lot of other factors as well. This is the first election since most of the factions within the LDP were disbanded in the wake of the funding scandal, one of the things that brought down Kishida himself. So it's very unclear, talking to analysts, what way lawmakers might vote, what way are the senior figures who are going to be the kingmakers in this, what way are they going to direct their allies to vote? Are they going to be able to direct their allies to vote at all? It's very uncertain at the moment, and that sets the stage for what might be a more interesting than normal, I think, election to determine effectively the next Prime Minister of Japan.
The space in policy differences between the candidates does not seem to be that wide, right? Whether you're talking about support for the BOJ or, broader views on defence spending, or even sort of the views on the relationship with China. So we were talking to Temple University earlier, saying like the era of, the Shinzo Abe personality, charisma politics doesn't seem like it's going to make a return, even with this newfound chaos.
It very much depends on what direction the party chooses to go. One of the things that I think has brought down Kishida is the fact that, there is a general election looming. It doesn't need to be held for another year, but it is, it is coming. And generally speaking, the LDP would prefer to call it at a moment of their choosing rather than wait until it has to be called in October of next year. That means that a lot of lawmakers will be looking, they'll be eyeing their seats, they'll be wanting to see that, you know, they're going to be able to get re-elected. Under Kishida, that wasn't going to happen. So I think the question is how desperate are lawmakers going to be? Who are they going to turn to in order to ensure that they get re-elected in the next election? They might turn to someone who's popular with the public, but whose policies might not be, you know, exactly in line with what we've come to expect. That opens the door for people like Shigeru Ishiba, Taro Kono, who you had on the show quite recently. I recall a lot of people are talking about Shinjiro Koizumi, who is, you know, quite inexperienced as a lawmaker, but who has been touted as someone who could eventually, you know, follow in his father's footsteps. A lot of those would be very, I think, quite personality driven leaderships, especially, and this is, I think, the in contrast to Kishida, who was very much a centrist kind of middle of the road character who was able to bring in, you know, all lines of the party within. If they choose someone like that in order to boost their own, you know, chances of survival, that might make for, I think, quite an interesting phase in Japanese politics.
Garo Reedy, Bloomberg Opinion columnist covering Japan and Korea. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're looking at when it comes to European futures, just opening up for the session. Stocks 50 futures are looking modestly positive, about 0.2% higher there. We're also seeing a little bit of upside when it comes to trading in German DAX futures as well. At the moment, it's sort of a mixed picture here in Asia. We had the US CPI number that really sort of didn't move the dial too much when it comes to Fed expectations. We're seeing a little bit of edging up higher of Asian equities in the early part of the session. Some of these market jitters are really kind of continuing to be calmed at this point, and we're watching for potentially that pass through to the European session. Watching energy stocks in particular, we've seen oil halting those 2 days of decline. Some of these geopolitical risks again in play, but we did see European gas prices in particular taking a slide again alongside some of the crude concerns. Really robust stockpiles are tempering a lot of these global supply concerns there. Coming up next, taking a look at Tencent posting better than projected earnings. A bit of a mixed bag there though. Alibaba and JD.com still to come later today. Analysis is next with Goldman Sachs. This is Bloomberg.
We're moving in the right direction.
I think it's pretty good news. The economy is still strong. Inflation is decelerating, and full steam ahead for the first rate cut on September 18th.
They want to cut rates. They're probably going to cut rates in September.
The market is leaning towards 50.
I don't think anyone should hold their breath for 50 basis points.
If they do a 50 basis point cut, it will probably spark an unnecessary concern in markets that they know something that we don't know, or something's happening in the economy.
We think 25 is the right first step towards easing policy.
Our base case remains for a 25 basis point rate cut in September.
If I'm the Federal Reserve, I want to try to get back to normal here, because the risk of recession, I think, is greater than the risk of any resurgence in inflation.
Bloomberg TV guest reacting to the U.S. CPI print that's bolstering bets on the Fed rate cut in September. Perhaps not an outsized cut, but a 25 basis point one. And this is the setup that we're seeing across Asia right now, with the Nikkei gaining 0.25%. Of course, we did just get the second quarter GDP number surprising to the upside. Of course, we are still contending with a little bit of political uncertainty, given that Prime Minister Kishida will not be running for a second term. The ASX 200 also gaining 0.2%. We're watching out for jobs numbers. Australia likely to add jobs at less than half the previous month's pace. Wage growth will probably exceed inflation by only a very small margin as well. When it comes to Kiwi stocks, not a lot happening right now, but this, of course, after the RBNZ cut interest rates a little bit faster than earlier indicated. Haidi.
And Shery, we continue to watch China Tech this week with the earnings coming through thick and fast, right? Tencent's ADRs fell in the US session as the tech giant's latest results showed pressure from weakness in the Chinese economy. Revenue came in slightly below estimates, with the fintech segment posting its slowest growth since 2022. That is despite the core gaming arm bouncing back from 2 straight quarters of declines, thanks to the blockbuster release of Dungeon and Fighter Mobile. Executives called the game their next evergreen hit, but did voice some caution over these cyclical challenges. Up next, Baba and JD.com. Earnings coming out imminently, and both businesses considered vulnerable, of course, to those fluctuations in broader consumer sentiment. Let's get some more perspective now with Ronald Keung, who's a head of Asia Internet Research at Goldman Sachs, who joins us from Hong Kong. Ronald, we were chatting briefly before, and I get the sense that, there was a bit of relief from you, right? Obviously, the focus is on the pass-through of the broader macro weakness through the fintech segment, but which of these numbers matters most to you for Tencent?
Yeah, so Tencent kicks off the results season amongst the mega caps, and with a over 50% earnings net profit growth, this does show that they continue to focus on this high quality revenue streams, and games have accelerated further to high single digit, and we've lifted our preference for games to the highest before the results season, and lowered internet verticals quite a bit, and then local services. This is our stacking order within China: internet games, followed by internet verticals, followed by local services. And therefore, I do think the Tencent games revenues and the grossing trends lived up to expectations. We're expecting mid-teens, close to mid-teens growth into the third quarter, and close to 20% kind of fourth quarter games revenue growth. This is on the back of very strong grossings, as you just mentioned, with a domestic new blockbuster game over DNF. Evergreen titles have been rejuvenated, and also very strong international games growth, particularly from Supercell. And this strength in games, however, is partly offset by some of the slower than expected advertising and payment growth, and we're now expecting more like a flattish payment growth into the second half of this year. The company did talk about that volumes remain strong for payment. However, the average ticket size have come down. This is the trend that we're seeing in China consumption, with lower ticket size, the consumption downgrade that we're seeing. Year to date, we've seen parcel growth has been very strong, but it's the ticket size declines that have been now filtering through our mega caps in payment volumes, in payment values terms, and also in e-commerce GMVs.
We've also heard kind of confirmation for the first time that they're in talks with Apple about these mini games mobile revenue. I know that you're already constructive when it comes to the revival of gaming, but does this just add a bit more bullishness when it comes to the broader developer ecosystem for China?
So within the domestic and international games, I would say there's always cooperation between the publishers and also through these app stores and play stores. This cooperation goes with revenue sharing and some of the cuts that these play stores and app stores take. However, I think the company has mentioned about the continued trend of some of the lowering the revenue sharing with app stores. That trend that has been happening while they're still continuing their discussions with Apple. Overall, we think the domestic dominance of Tencent's games is helped by the WeChat ecosystem, while on the international side, then it's the ongoing growing new titles and potential for expansion of different titles that will be more important than what we're talking about in different channel shifts on the charges, and they do see a manageable there, we do believe.
We saw a little bit of that reflection of the weaker macro environment in Tencent. How does this set us up for what we can expect from other tech giants like Alibaba and JD.com?
So with Alibaba reporting and JD reporting tonight, and we also expect PDD, one of the other key e-commerce players, reporting end of this month, we are seeing very strong parcel trends, as we've said, close to over between 20 to 30% parcel growth, while online GMV for China e-commerce has been growing at around mid to high single digits. So this consumption downgrade, lower ticket size continues to happen. We think this year it continues to be the theme of fight back of the incumbents that we have been mentioning since the beginning of this year. Fight back of the incumbents in Alibaba, striving for GMV growth, we think partly at the expense of profits, reinvesting into growth, while we're expecting on the JD side, generally more muted growth on the category exposure, but we do expect a healthy growth in JD. So the fight back of the incumbents comes in a very different strategy, slightly contrasting strategies between the incumbents, either GMV growth at slightly expense of profits in the near term, but striving for longer term stability of market share at Alibaba, while JD focuses on the balance between growth and profitability. What we've seen is a slowdown in live stream e-commerce this year, and that has given our traditional e-commerce players a chance to re-accelerate their growth, and we're expecting one of the solid prints from the PDD front on strong advertising growth, while delivering profit continue to improve on improving profitability of the international business, Temu. Geopolitical and going global remains one of the themes for this year, but with more geopolitical attention and therefore some of the scrutinies there. But we think this segment continues to be a high growth segment within Alibaba and PDD, with them going global.
Ronald, so you mentioned really the contrast with JD.com when it comes to profitability and focusing on that more than, say, growth in other areas. How do these tech giants in China manage to keep that balance where you're really wanting to strive for profits, but also at the same time not lose market share in a very, as you alluded to, competitive environment now?
Yeah, so I do believe these companies will continue to assess on a quarter-on-quarter basis and continue to balance growth and profitability. But given the market share losses of Alibaba as a leader in e-commerce over the past few years, we do see some of their re-accelerating growth, putting users first, driving competitive pricing and good user experience with buy now, pay later, refund policies. All of those have driven some of the re-acceleration in GMV growth at Alibaba. What is needed now is any strategies on improving the monetization rates of their Taobao Mall, and therefore translate to earnings in our views in the next few quarters, despite the earnings decline that we expect in the June quarter, inflections coming in towards the end of this year and early parts of next year, as improving GMV translates to improving ad and commission revenues, and therefore the inflection for earnings.
Ronald, really great to have you with us. Ronald Keung, who's the head of Asia Internet Research at Goldman Sachs. Well, Chinese stocks continue to fall out of favour. Volumes and turnover are collapsing, and value of shares traded on the Shanghai Comp is now at the lowest level since 2019. It clearly, as you can see from this Bloomberg terminal, showing buyers are absent ahead of what is really a busy earnings season. And perhaps you can't blame them, Shery, given we're expecting the domestic activity data today to just really reiterate this slowdown trajectory.
Yeah, and this, of course, as we continue to watch more idiosyncratic company news. On the corporate front, these are the stories that we're following. UBS shares jumping after it posted higher than expected profit in the second quarter. Investment banking revenue and progress in integrating Credit Suisse helped bolster efforts to return capital to shareholders. Net income of $1.1 billion was about double analyst estimates. Growth in deal-making revenue at the investment bank beat many Wall Street peers. The latest attempt to resume talks between BHP Group and striking Chilean copper miners has broken down as the two sides failed to agree on conditions. According to the union, one of BHP's conditions was a suspension of the strike, which began on Tuesday. This required approval from members, a process that couldn't be completed in time to meet BHP's deadline. Bloomberg has learned that Apple is also ramping up work on a home tabletop device as it seeks new sources of revenue. Sources say a team of several hundred people is working on the product, which uses a thin robotic arm to move around a large display screen. It's envisioned as a smart home command center, video conferencing machine, and a home security tool as well. Coming up next, more on China's economy as the government takes steps to cool a massive bond market rally, while the world's biggest steel producer warns of a severe industry crisis. This is Bloomberg.
Take a look at how bonds in this part of the world are trading. In particular, we're seeing some big moves when it comes to expectations of how the RBA might respond, particularly if we get a further softening of the jobs market. We're seeing Australian yields hitting that 13-month low on these bets that the Reserve Bank is inching closer to the start of an interest rate cut cycle. Of course, the RBNZ just across the way yesterday embarking on its easing cycle much sooner than expected. Bond investors have been shrugging off a relatively hawkish stance from the RBA, at least compared to those peers. Of course, they most recently kept rates at that 12-year high earlier this month and actually ruled out a cut in the next 6 months, but markets are seeing otherwise. That jobs report due out later on Thursday. Taking a look at China now, scrambling to halt this decline in its government bond yields using various window guidance methods, including asking some rural banks not to settle purchases. Our Bloomberg Opinion columnist Shery has views on this and joins us now. And Shery, we always love to get your views, but first and foremost, you say these measures could quite easily backfire.
Yes, absolutely. I mean, a sudden spike in government bond yields can be very dangerous, as China has seen in late 2022 when it abruptly abandoned the COVID zero policy. What we are seeing this year is that there are a lot of rural commercial banks buying into the long-dated government bonds, and the consumers, China's households, coming into the bond market via bond mutual funds because, long-term bonds are offering better yields, better returns than the savings account. But the Chinese consumers have been very skittish. I mean, what they've seen is a slump in their home prices, a slump in the stock market. And as soon as they see that their bond funds are not making money, they can have a huge exodus, and we can see a big redemption in the bond mutual funds. So that can be very dangerous, and China may be getting more than what it's asking for.
So, Shery, here in Japan, the Bank of Japan is finally starting to normalize policy, has given up on yield curve control. Over there in Beijing, we're seeing its own way to try to get through YCC. What exactly are authorities trying to do here?
They basically want to, China likes to control everything, right? They want the people to be well behaved, and they also want the bond market to be well behaved in the sense that they don't want the inverted yield curve. And granted, inverted yield curve is kind of dangerous because it ruins banks' financial health. But what they want is that, the 10-year bonds still have some premium over the 7-year policy rate, and the 30-year bonds are yielding more than the 10-year. But the China's yield curve is getting flatter and flatter. That's why they want to basically prop it back up to steepen it and make it more well-behaved. But it's not clear at all whether that's going to work.
Our Bloomberg Opinion columnist Shery there with her take on all of the shenanigans that we've seen in China's bond markets. And we're also watching for, in particular, Shery, in light of what we've seen with the big drop in commodities prices, the pressure coming down on Australian iron ore in particular, a lot of pressures when it comes to steel prices in China. In fact, if you take a look at this terminal, it kind of shows you just how steep a drop that we're seeing, that China's steel prices have dropped to the lowest level since 2014. You've got that in the bottom section, producer price inflation, so factory gate prices just underscoring that very close relationship between overcapacity issues hounding some of these traditional metals related industries. And we heard from the world's biggest steel producer really sounding the alarm about what it sees as an industry crisis in China. China Baowu Steel Group, the chairman Hu Wangming telling staff at the company's half-year meeting that the steel sector are looking at conditions like a harsh winter that will be longer, colder and more difficult to endure than expected. And of course, this has really, Shery, the potential to ripple around the globe and further plunge the sector and some of these related sectors into quite severe, downtrends.
Yeah, at a time when we're very much focused on a potential downturn when it comes to the global economy. Of course, we've just been talking about China's weaker economy, struggling. We're potentially contemplating a recession in the United States, depending on whether or not we achieve that soft landing by the Fed. But you can see iron prices have been dropping, sinking to the lowest in a year. That was the level for the previous session, and the drawdown now on the second panel is now nearing about 30% from the January peak as well. Coming up, a court removes Thailand's prime minister from office as the royalist establishment reasserts its grip on power. An update from Bangkok next. This is Bloomberg.
This is the Asia Trade. The top stories that we're following this hour. The World Health Organization is calling the Mpox outbreak in Africa a global health emergency. A mutated strain of the virus has spread to at least 6 African countries, including and infecting some 15,000 people and killing over 500 this year. Mpox causes painful rashes and lesions that is spread through close contact with an infected person or animal. Russia says it's expelled a wave of Ukrainian drones and missiles in one of the largest overnight attacks of the war. Moscow says 117 drones were shot down over almost all border regions, as a region east of the capital. Ukrainian forces say they continue to advance into Russian territory as Moscow rushes reinforcements to the Kursk border region, where Ukraine says it seized control of more than 70 towns and villages. A new Quinnipiac University poll suggests that Democratic presidential nominee Kamala Harris is leading her Republican opponent Donald Trump in a swing state of Pennsylvania. The survey gives Harris 48% support to 45% for Trump, with 4% backing Robert F. Kennedy Jr. Harris is set to formally accept the nomination next week at the Democratic National Convention in Chicago. Shery.
And Haidi, we continue to watch the political developments in Thailand. The Constitutional Court has dismissed Prime Minister Srettha Thavisin from office after finding him guilty of an ethics violation. For more, Bangkok reporter Papisha Tanaka-Sempipa joins us now. Papisha, so this ouster coming in less than 12 months since he took office, what happens next?
Well, Shery, and now that Srettha's out, we are once again without a leader and entering a new period of political uncertainty. And as you said, so soon after the general election last year. Now, the good news, though, is that the process to select a new prime minister is already underway. The House of Representatives will meet on Friday morning on this very matter. And to recap, there are 6 candidates who are eligible to become prime minister in the current coalition, that it is expected that the Pheu Thai party will try to retain the premiership. Now, what remains to be seen today is how the coalition parties will react to this sort of arrangement and whether it will throw the support behind Pheu Thai's nomination on Friday.
In terms of who's expected to be nominated for PM, what are we looking at?
Pheu Thai is expected to nominate the 75-year-old former Attorney General Shaikasem Niti Siri Haidi, but Pheu Thai still has another eligible candidate in Pattongthan Shinawat, who is the current party leader and the 37-year-old daughter of former Prime Minister Thaksin Shinawat. It's also not completely impossible that the coalition parties might reject Pheu Thai's nomination on Friday and even spring a surprise by challenging it in the vote. And if that happens, then the prime minister candidate that we need to watch out for outside of Pheu Thai would be Anutin Chanwayargun, who is the leader of the second biggest party in the coalition, Phum Jai Thai.
I guess a question is also, will the coalition then stick together?
That's a very good question, because the successful prime minister candidate will need more than half of the support of the lawmakers in the House. So the vote on Friday will be a test of unity for the coalition. But mathematically speaking, they do need to stick together if they want to retain or stay in power, because the only other alternative would be to break up and join hands with the common enemy, which is the opposition People's Party, which does not seem likely at this stage. So Pheu Thai must really focus its efforts today on bringing the coalition parties to the negotiating table and try to ensure that they together can win the prime minister vote in one go on Friday to try to form a government as soon as possible.
Bangkok reporter Papisha Tanaka-Sempipat there with the latest on those political developments in Bangkok. And take a look at how markets are trading early in the Asia session. We're talking about the Japanese stock market continuing to gain ground now for a fourth consecutive for a fourth consecutive session. But suffice it to say, Heidi, that we're really back to those levels before the big Black Monday plunge that we saw last week. We just got more positive second quarter GDP data than was expected. And of course, on your neck of the woods, we do have Australia jobs numbers coming up. The ASX 200 up 0.6%.
Yeah, Shery, it's really interesting seeing the move in bonds because clearly traders are setting up this narrative that the RBA is also close to its start of its easing cycle on the back of what we saw from the RBNZ sort of surprising markets by going earlier than expected yesterday. Of course, we have heard from the RBA still that relatively hawkish bias. They don't intend to cut in the next 6 months, but of course, the reality is data dependent as always. So we'll wait to see what we get with from those jobs numbers. Expected to potentially see unemployment continue to tick up despite a broader improvement in labour market conditions. This is a futures session that we're seeing at the moment. A little bit of positivity extended though into another session for S&P futures. TAIEX futures also looking like we could get a little bit of a boost. China domestic activity data will be on tap later on in the session. We're seeing that weakness for A50 China futures. We're not expecting much of an improvement, particularly when it comes to some of the weakness through retail sales as well as industrial production. This is Bloomberg.